Markets kicked off the week of September 15, 2025, with a surprising surge of optimism. After weeks of uncertainty and mixed signals, investors seemed ready to embrace a more positive outlook, at least for the moment. Global stock indexes from Asia to Europe and the US opened in the green, fueled by hopes that the Federal Reserve might soon cut interest rates. This wave of optimism swept across continents as traders and analysts alike speculated about the potential for a shift in monetary policy. Investors are betting on cheaper borrowing costs, which could boost corporate investment and consumer spending. Lower rates would make it easier for businesses to expand and for households to borrow, potentially giving the global economy a much-needed boost. The rally was broad, with European benchmarks joining the upward momentum, signaling renewed confidence in the global economy. Even markets that had been lagging in recent weeks saw a lift, as optimism spread beyond just Wall Street. Yet, this optimism is fragile. No official Fed announcement has been made, and any hawkish signal could quickly reverse gains. Investors remain wary, knowing that a single statement or data release could send markets tumbling just as fast as they rose. The market's upbeat mood is a bet on future policy, not present certainty. Traders are essentially gambling on what the central bank might do next, rather than reacting to concrete changes. Investors are walking a tightrope, balancing hope for rate cuts against ongoing economic and geopolitical risks. Concerns about inflation, global conflicts, and supply chain disruptions still linger in the background, tempering enthusiasm. The positive open highlights just how sensitive markets are to every move and word from the Federal Reserve. Even the smallest hint of a policy change can trigger dramatic swings in sentiment and prices. For now, cautious optimism prevails, but the foundation remains shaky. Market participants know that the situation could change rapidly, and many are keeping a close eye on upcoming economic data and central bank meetings. The week begins with hope, but volatility is just a headline away. As investors brace for the days ahead, uncertainty remains the only constant in these unpredictable markets. The tech sector faced turbulence as global markets reacted to unexpected regulatory moves. China's antitrust regulator launched a high-profile investigation into Nvidia, alleging violations of anti-monopoly laws and putting the world's leading chipmaker under intense scrutiny. Nvidia's shares tumbled in pre-market trading, and the shockwaves hit chipmakers worldwide, underscoring just how deeply the sector relies on China for both supply chains and revenue. The probe signals a major escalation in the US-China tech rivalry, with Beijing flexing its regulatory muscle in response to American export controls and ongoing trade disputes. By targeting Nvidia, China is sending a clear message to US tech firms. Access to its vast market now comes with new risks, and the rules can change quickly. The timing rattled investors, reminding them that geopolitical tensions can erase billions in value overnight, regardless of a company's fundamentals. The move highlights how deeply tech stocks are now entangled in global politics, not just innovation and earnings, but also in the shifting sands of international relations. For investors, it's a wake-up call. Diversify and stay alert to the shifting regulatory landscape, as the next headline could change everything. The fate of US tech in China is now a high-stakes game with unpredictable rules, where every move is watched and every decision could have global consequences. This investigation could reshape the competitive landscape for years to come, influencing not just Nvidia but the entire tech ecosystem. The message is clear: no tech giant is immune from the crossfire, and even the biggest players can be brought to heel by regulatory action. The sector's future depends as much on diplomacy and international cooperation as on technological breakthroughs and innovation. The market's reaction was swift, and the risks are real, reminding everyone that in today's world, technology and geopolitics are inseparable. China's scrutiny of Nvidia was just the beginning. What started as a targeted investigation has quickly grown into a much broader campaign, signaling a new phase in the ongoing tech rivalry between the world's two largest economies. Over the weekend, Beijing expanded its probe to include U.S. analog chip imports, escalating the tech standoff. This move marks a significant escalation, as analog chips are essential components in countless modern devices. Analog chips power everything from smartphones to cars, medical equipment to industrial machines, making this a direct threat to the U.S. electronics supply chain and the global tech ecosystem. The move is clear retaliation for U.S. export controls aimed at stifling China's chip ambitions. Both sides are now using their regulatory powers as weapons in a high-stakes battle for technological dominance. Each side's actions risk spiraling into a full-blown tech trade war, with new restrictions and countermeasures being announced at a rapid pace. For American chipmakers, China is both a massive market and a critical supply chain hub. Any disruption could hammer revenues, threaten jobs, and shake investor confidence. The widening probe shows no part of the U.S. semiconductor industry is safe from regulatory pressure. Even companies that once felt insulated are now facing new uncertainties. The global implications are huge. Supply shortages, higher prices, and slower innovation could follow. The ripple effects will be felt by manufacturers, retailers, and consumers worldwide. Companies may be forced to redesign products and reroute supply chains, driving up costs and delaying product launches. The entire industry is being forced to adapt on the fly. The tech world is fragmenting along geopolitical lines with long-term consequences for everyone. The era of seamless global collaboration in technology may be coming to an end. The stakes are rising and the risks are spreading. Markets are reacting with volatility, and uncertainty is becoming the new normal. For consumers and investors, the chip war is no longer abstract. It's about to hit home. Everyday products could become more expensive or harder to find. The global tech landscape is being redrawn in real time, and the outcome will shape the future of innovation, commerce, and daily life for years to come. Amid the chip war, U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng met in Madrid for high-stakes talks. These closed-door meetings aim to keep competition from spiraling into open conflict. The agenda is packed: trade imbalances, market access, and the tech disputes rattling markets. Any sign of progress could boost investor confidence. A breakdown could trigger fresh volatility. The outcome will shape the rules of global trade for years to come. Even small steps toward understanding would be a win for global stability. The talks are a reminder that diplomacy is as crucial as policy in today's interconnected world. For businesses and investors, these negotiations are as important as any central bank decision. The stakes are high, and the world is watching. Madrid could be the stage for a turning point, or another escalation. The future of global trade hangs in the balance. One hot topic in Madrid: the fate of TikTok. The U.S. demands ByteDance sell TikTok's American operations or face a ban, citing data privacy and national security. Treasury Secretary Bessent hinted that a resolution is near, sparking hope for a deal that could avert a ban. Any agreement would likely involve strict U.S. oversight while letting ByteDance retain some ownership. A solution would be a diplomatic win, securing U.S. data and avoiding a forced sale. It could also serve as a model for resolving other tech disputes. The potential TikTok breakthrough shows that negotiation can still work, even amid rivalry. If finalized, it could ease tensions and reduce market risk. The details remain secret, but the possibility of compromise is a positive sign. Communication channels are open, and diplomacy isn't dead. In Washington, the Senate prepared to vote on Stephen Miran's nomination to the Federal Reserve Board, just before a crucial Fed meeting. The timing is key. Miran's confirmation could influence the Fed's stance on interest rates. Investors are watching to see if he's a hawk or a dove, as his vote could sway the committee's direction. The political push to confirm him highlights growing partisanship around the Fed. The central bank's independence is under pressure, complicating its mission. For markets, the outcome adds another layer of uncertainty to an already tense week. Miran's confirmation could temper expectations for imminent rate cuts. The Senate's decision will be scrutinized as closely as any economic data. Politics and policy are now deeply intertwined at the Fed. The ripple effects will be felt across the financial system. The U.S. dollar weakened against major currencies like the pound and yen, reflecting shifting expectations for Fed rate cuts. As investors anticipate lower U.S. rates, the dollar's appeal fades, prompting capital to flow elsewhere. A weaker dollar benefits American exporters and multinational companies, boosting overseas profits. It also makes the U.S. more attractive to foreign tourists. But there's a downside. Imported goods get pricier, fueling inflation and raising costs for consumers. Americans traveling abroad will feel the pinch too. For investors, currency swings add complexity and risk. The dollar's dip signals a changing global financial landscape. The move is small but significant. Markets are adjusting to a new reality. The world is watching the Fed, and currencies are moving in anticipation. The dollar's direction will shape trade, travel, and investment in the months ahead. The global economy is shifting, and the dollar is at the center. In France, the CAC 40 index edged higher despite a Fitch credit downgrade, showing investor resilience. Optimism over potential Fed rate cuts outweighed local fiscal worries. The market's strength signals confidence in France's economic fundamentals. Meanwhile, oil prices ticked up as the U.S. urged G7 allies to tighten sanctions on Russian oil. Any coordinated action could disrupt global supply and push prices higher. Rising oil costs threaten to fuel inflation and slow economic growth worldwide. Even talk of new sanctions is enough to make traders nervous. The energy market remains highly sensitive to geopolitical developments. For consumers, higher oil prices mean more expensive fuel and heating. Europe's markets are balancing local challenges with global forces. The ripple effects are felt far beyond the trading floor. What does all this mean for you? The Fed's potential rate cuts could lower borrowing costs and boost your investments. But tech tensions, like the Nvidia probe, create volatility. Diversification is key. The chip war may drive up prices for electronics and cars, hitting consumers directly. Diplomatic progress, like a TikTok deal, can calm markets and reduce risk. The Fed's decisions and the dollar's moves affect everything from mortgage rates to travel costs. Oil price spikes mean higher gas bills, squeezing household budgets. France's market resilience shows sentiment matters as much as fundamentals. The global economy is a web. Every headline can impact your wallet. Stay informed, but don't panic. Understanding these forces helps you make smarter financial choices. Markets will always react to news, good and bad. Being prepared is your best defense in a shifting world.